If you had $10,000 to invest today, where would you put it? Would you back the Australian Stock Exchange or would you buy US companies like Apple and Microsoft? Most people answer that question in about 2 seconds, but here's the thing, they're usually comparing the wrong things. It isn't really about which country is better, it's about what job you want your money to do. Once you look at it that way, the answer becomes a lot clearer. So by the end of this video, you'll know which option is likely to make more sense for you. This is one of the first big decisions almost every Aussie investor runs into. You open a brokerage account, you're looking at thousands of investments, and before long it feels like you've got two paths. You either stick with the Australian companies you know, or you buy the big US companies that seem to be in the news every other day. Most people pick one fairly early and never really think much about it again. Then a few years later they compare their portfolio with a mate who went the other way. And suddenly they're wondering why the results look so different, even though both of them thought they were making the sensible choice. So let's break it down properly. We'll have a look at why plenty of Australians still like investing in the ASX, including dividends, franking credits, and why not having to worry about currency movements can actually be a bigger advantage than people realize. Then we'll jump over to US stocks and talk about why companies like Apple, Microsoft, NVIDIA, Amazon, and Google have attracted investors from all over the world. And by the end, we'll figure out how to think about which one actually suits your goals. Because to be honest, for a lot of people the answer isn't choosing one over the other. It's owning both, just in different proportions. Before we get into it though, just a quick disclaimer. I'm not a financial advisor, and this video is general information, not personal financial advice. Your goals, your timeline, and how much risk you're comfortable with can all change the right answer, so think of this as a starting point for your own research, not a final recommendation. Alright, let's start with the ASX because I reckon it's probably the more underrated side of this comparison. One of the biggest strengths of the Australian market is income. A lot of our larger companies, especially the major banks and mining businesses, tend to pay higher dividend yields than many companies in the US. On top of that, many of those dividends come with franking credits. Without getting too technical, it basically means the company has already paid tax on those profits before the dividend gets to you. If you're an eligible Australian investor, those credits can reduce the amount of tax you owe, and in some situations you might even receive a refund. That's a benefit that's fairly unique to Australia and one that can make a real difference over time. Another thing people don't always think about is currency risk. When you invest in Australian shares, you're investing and getting paid back in Australian dollars. You don't have to worry about exchange rates moving against you while you're holding the investment. It might not seem like a big deal day to day, but over the long run, currency movements can have a noticeable impact on your returns, and a lot of people don't really appreciate that until they've experienced it themselves. Now, that doesn't automatically mean the ASX is the better investment. Higher dividends don't always mean higher overall returns, and that's where a lot of people get caught out. The Australian share market is also much smaller than the US market, and it's heavily concentrated in sectors like banking and mining. If you're looking for reliable income and you like investing in businesses you understand and hear about every day, that's not necessarily a bad thing. In fact, for plenty of Australians, it's exactly what they're after. It's easier to follow local companies because they're part of the economy you're living in every single day. The trade-off is that you're missing out on a lot of the world's biggest technology companies, simply because they aren't listed here in any meaningful way. So the real question isn't whether the ASX is good or bad. It's whether steady income, simplicity, and a familiar market are actually what you're looking for right now, or whether your goals are pointing you somewhere else. Now let's flip over to the US market, because this is usually the side that gets all the attention, and to be fair, there's a good reason for that. Here's something a lot of people don't realize. The Australian share market only makes up a small slice of the global stock market, while the US accounts for well over half of the world's total market value. So when you hear people talking about having exposure to US shares, it's not because they're chasing the latest trend. It's simply where a huge number of the world's biggest listed companies happen to be. And you can see that straight away when you look at the names. Investing in US stocks gives you direct access to companies like Apple, Microsoft, NVIDIA, Amazon, and Google. These are businesses that have shaped the way millions of people live and work, and the reality is we just don't have Australian companies that are comparable in size or global reach. Over the past decade, a lot of the strongest growth in the share market has come from large US technology companies. Now that doesn't mean it'll keep happening. Past performance never guarantees future returns, but it does help explain why so many investors look beyond Australia when they're thinking about long-term growth. That said, investing in the US isn't just about buying great companies and calling it a day. There are a couple of extra things you've got to keep in mind. The first one is currency risk. When you buy US shares, your investment isn't only affected by how the company performs, it's also affected by the exchange rate between the Australian dollar and the US dollar. So it's entirely possible for two people to buy exactly the same US stock, but end up with different returns once everything's converted back into Aussie dollars, simply because they invested at different times. That's something a lot of new investors don't think about until they actually see it happen. The second thing is US dividend withholding tax. If a US company pays you a dividend, part of that payment may be withheld for tax before it even reaches your account. On top of that, US companies generally pay lower dividend yields than many Australian companies anyway. So if you're investing mainly for income, it's worth understanding that your dividend payments can end up being lower than you might expect. The interesting part is that neither of these costs really jumps out at you. They don't usually show up as a big fee or a warning message. They just quietly sit in the background, influencing your returns over time. And when people are disappointed with how an investment performed, they often blame the company itself, when in reality, currency movements or withholding tax might have played a bigger role than they realized. So does that mean US stocks aren't worth it? Not at all. It just means you need to understand what you're getting. In return for taking on those extra risks, you gain access to some of the world's largest, most innovative businesses and a market that's far bigger and more diversified than Australia's. For many investors, that's a trade-off they're perfectly happy to make, especially if their focus is on long-term growth rather than generating income today. So, when you come back to the question we started with, it's probably a bit clearer now. It was never really about choosing Australia over the US. The real question is, what are you actually trying to achieve with your money? If your priority is generating a steady income, the ASX has some pretty clear advantages with higher dividend yields and franking credits. If you're more focused on long-term growth, the US market gives you access to a much bigger share of the companies driving innovation around the world. The mistake a lot of people make isn't choosing one market over the other. It's thinking they have to choose only one. When you look at what experienced Australian investors do, plenty of them don't treat it as an either-or decision. They own Australian shares for income and local exposure while also investing in US companies for global growth. That way, they're not relying on just one country's economy or one group of industries. It's a simple idea, but over the long run, it can make a portfolio a lot more balanced. So just to bring everything together, the ASX offers higher dividend yields, franking credits and no currency risk, but it's a smaller market that's heavily concentrated in sectors like banking and mining. The US market gives you access to many of the world's biggest companies and a much broader range of industries, but it also comes with currency risk and US dividend withholding tax. Neither option is automatically better. It really comes down to what fits your own goals and how you want your portfolio to grow over time. The tricky part is that you probably won't know whether today's decision was the perfect one until years down the track. Investing doesn't give you instant feedback. That's why spending a bit of time thinking through your strategy now is usually a much better approach than making a decision just because everyone else seems to be doing it. If you've got a mate who's only ever invested in one of these markets and has never really stopped to think about why, send this video their way. It might give them a completely different perspective, and I'm keen to hear what you do. If you had $10,000 ready to invest today, would you put it into the ASX, the US market, or would you split it between both? Let me know down in the comments. Thanks for watching, and I'll see you in the next one.